episodes, we discussed equity mutual funds and debt mutual funds, their pros and cons, and their various types. Now, let's dive into hybrid mutual funds. As the name suggests, hybrid mutual funds combine the characteristics of both equity and debt mutual funds. Equity mutual funds involve some level of risk but offer higher returns, while debt mutual funds are considered safer but yield lower returns. Every investor has unique needs, preferences, and risk tolerance levels, which also influence their expected returns. This is where hybrid mutual funds come into play. Hybrid mutual funds cater to investors seeking the best of both worlds. If you desire a blend of the advantages offered by both equity and debt funds, hybrid mutual funds are an excellent choice. They provide a balanced approach aiming to deliver the benefits of equity's growth potential and debt's stability and income generation. Let's delve deeper into how they work. Hybrid funds are a mix of equity and debt, tailored to meet the investor's preferences. Each hybrid fund is distinct, with varying allocations for equity and debt. So, how do they function, and when can you expect returns? Hybrid funds aim to create a well-rounded portfolio that offers regular income and long-term capital appreciation. The fund manager plays a pivotal role here. They craft the perfect blend of debt and equity based on market dynamics and make asset purchases and sales accordingly. What are the different types of hybrid funds? 1. Equity-oriented funds. As the name suggests, these funds have a higher proportion of equity investments, typically least 65% of the total assets. These investments span various market capitalizations and sectors, with the remaining 35% allocated to debt securities. 2. Debt-oriented funds. In this category, a minimum of 60% of the fund is invested in fixed income securities like bonds, debentures, and government securities. The remaining 40% is allocated to equities, and fund managers may also invest some funds in liquid schemes. 3. Balanced funds. Hybrid funds in this category usually invest between 40% to 65% in equities and equity-related instruments, with the remainder in other securities and cash. For tax purposes, if the majority of the investments are in equities, it is treated as an equity fund, offering tax exemptions on long-term capital gains up to a certain limit. Conversely, if the majority of the investments are in debt, it is treated as a debt fund. Balanced funds aim to diversify the investment portfolio, reducing overall risk, making them suitable for those seeking long-term capital appreciation with lower short-term risk. 4. Monthly Income Plans, MIP. MIPs primarily invest in fixed income securities while allocating a smaller portion to equity funds. The objective of these funds is to provide investors with regular income through dividends or interest payments. Most MIPs also offer a growth option. 5. Arbitrage funds. These are equity-oriented hybrid funds where fund managers exploit price differences between markets by buying stocks in one market and selling them at a higher price in another. However, timing is crucial, and when arbitrage opportunities are limited, fund managers may invest in debt securities or cash. These funds are relatively safe but are taxed like equity funds. 6. Dynamic Asset Allocation Funds. This category diversifies investments across various sectors, including equities, real estate, and bonds. During market uncertainties, these funds are advantageous because the fund manager reallocates investments from underperforming sectors to better performing ones. They are considered stable in the long run, and the diversification across multiple sectors can offer tax benefits. 7. Equity Savings Scheme (ESS) funds. In ESS funds, approximately 30 to 35% of the investments are allocated to equity assets, while the rest is divided between debt income funds and arbitrage opportunities. Fund managers capitalize on price disparities in different equity markets, earning profits through arbitrage. ESS funds function similarly to balanced funds but also harness the potential of arbitrage. These funds focus on risk reduction while striving on higher returns. Now that we understand what a hybrid fund is, the decision of whether to invest in it or not depends on individual preferences and risk tolerance. Investing in hybrid funds involves two important considerations. Firstly, you need to assess the risk-return profile. In simpler terms, you should evaluate the risk associated with the assets in your portfolio. For example, if you invest in an equity-oriented fund, you should analyze the risks related to the individual stocks in your portfolio, such as whether they are large cap or small cap stocks. This analysis will help you estimate the expected return from your investment. Secondly, it's crucial to choose the right hybrid fund for you. How much risk are you willing to take? How much regular income do you require? What are your return expectations? Have an open discussion about these factors with your fund manager. Avoid selecting a fund simply because everyone else seems to be doing it. Instead, always engage in a thorough discussion before making a decision. In conclusion, it's important to note that hybrid funds are somewhat riskier than debt funds, but safer than equity funds. Consequently, they are expected to offer better returns than debt funds because, as mentioned earlier, higher risk often leads to higher returns. Another significant point to consider is that since hybrid funds also invest in equity assets and require active management, their expense ratio becomes almost similar to that of equity funds, even though their returns are lower. Some experts consider them a compromise, but for new investors who might hesitate to directly invest in equity funds due to their lower risk tolerance, hybrid funds can be an attractive option. They allow investors to potentially earn higher returns than debt funds, gain experience in equity investments, all while maintaining a lower level of risk.